You make $80,000 a year. The bank says you can afford a $400,000 home. But here's what they're not telling you. That number will absolutely destroy your finances. Stay right here, because the next 10 minutes will change how you think about buying a house forever. Hey, welcome back. If you're new here, this channel is about money that actually makes sense in real life. Not theory, not fantasy, real numbers. Today we're answering one of the most searched questions in personal finance. How much house can my salary actually buy? And the key word there is actually, because there's what the bank tells you, and then there's reality. They are very different things. We're going to cover both, and by the end of this video, you'll know your real number. Not the number that gets you approved, but the number that lets you sleep at night. Let's get into it. The bank's number vs. your number. When you apply for a mortgage, the bank runs something called a debt-to-income ratio, or DTI. Most lenders will approve you if your total monthly debt payments, including your new mortgage, are 43% or less of your gross monthly income. Let's use a real example. Say you make $80,000 a year. That's about $6,667 per month gross, before taxes, before anything. 43% of that is roughly $2,167 a month the bank is willing to let you spend on debt payments. If you have no other debt, no car loan, no student loans, no credit cards, that $2,867 is all going toward your mortgage. At today's rates, around 7%, that payment on a 30-year loan corresponds to roughly a $430,000 home. The bank will hand you a pre-approval letter for $430,000, and it will feel amazing. Here's the problem. That calculation is based on your gross income, money you haven't actually received yet. After federal taxes, state taxes, Social Security, and Medicare, that $80,000 salary is probably closer to $55,000, $60,000 take-home, depending on your state. That's about $4,600 a month in your actual bank account. Now that $2,867 mortgage payment isn't 43% of your income, it's closer to 62% of your take-home pay. You'd have $1,700 left every month for food, utilities, car, insurance, kids, emergencies, retirement, everything. That's not home ownership, that's being house poor.
The rules, and why one is better than the others.
There are 3 common rules people use to figure out how much house to buy. Let's break them all down. Rule number 1, the 28-36 rule. This says your mortgage payment should be no more than 28% of your gross monthly income, and your total debt payments should be no more than 36%. On $80,000 a year, 28% of gross monthly income is about $1,867 a month. That gets you a home around $280,000 at 7% interest. Rule number 2, the 3X rule. This one is simple. Buy a house that costs no more than 3 times your annual salary. At $80,000, that's $240,000. Rule number 3, the bank's 43% DTI rule, which, as we just saw, can get you approved for $430,000 and potentially ruin your life. My recommendation: use the 28% rule as your ceiling, not your target. If you can get well under that, even better. The 3X rule is a good reality check, especially if you have other debts. The bank's rule? Use it to understand what you can borrow. Never treat it as what you should borrow. The costs nobody talks about. Here's where a lot of first-time buyers get blindsided. Your mortgage payment is just the beginning. Let's talk about what homeownership actually costs. Property taxes. Depending on where you live, this could be 0.5% to 2.5% of your home's value per year. On a $300,000 home, that's $500 to $7,500 a year, often rolled into your mortgage payment, but still real money. Homeowners insurance. Plan for roughly $1,000, $2,000 a year on average, more in disaster-prone areas. PMI, private mortgage insurance. If you put down less than 20%, the bank charges you extra, typically 0.5% to 1.5% of the loan per year. On a $300,000 loan, that's up to $4,500 a year, just for not having a big enough down payment. Maintenance and repairs. The classic rule of thumb is 1% of the home's value per year. On a $300,000 home, budget $3,000 annually. Some years it's zero. Some years the roof goes, or the HVAC dies, and it's $15,000. You need reserves. HOA fees. If you buy in a community with a homeowners association, fees can range from $100 to $1,000 plus per month. Always check this before you fall in love with a place. When you add all of this up, the true cost of owning that $300,000 home could be $500 to $1,000 a month, more than just the mortgage payment alone. This is why I always say, never look at just the mortgage payment. Look at the total cost of ownership. The real salary breakdowns. Let's get specific. Here's what different salaries actually translate to in home buying power, using conservative 28% rule math, assuming a 20% down payment, 7% interest rate, 30-year mortgage, and no other debt. $50,000 per year salary, gross monthly, $4,167.28% equals $1,167 per month for housing. That gets you a home around $175,000, $75,000 per year salary. Gross monthly, $6,250.28% equals $1,750 per month. Home price around $260,000, $100,000 per year salary. Gross monthly, $8,333.28% equals $2,033 per month. Home price around $350,000. $50,000 per year salary. Gross monthly, $12,500.28% equals $3,500 per month. Home price around $520,000. $200,000 per year salary. Gross monthly, $16,667.28%, your $4,667 month. Home price around $695,000. Now here's the thing. These numbers assume no other debt. If you have $500 a month in student loans or a car payment, subtract that from your housing budget first. Every dollar of existing debt directly reduces how much house you can responsibly afford. And these numbers look very different depending on where you live. $350,000 buys you a great home in many parts of the Midwest and South. In San Francisco, New York, or Seattle, that same $350,000 might not even get you a one-bedroom condo. How to actually prepare. Okay, so now you know your number. What do you actually do with it? Step 1. Get your credit score above 740. Your credit score directly impacts your mortgage rate. Going from a 680 to a 740 could save you 0.5% on your rate, which on a $300,000 loan is over $30,000 across the life of the loan. That's not a small thing. Step 2. Save a real down payment. 20% down eliminates PMI entirely and gets you better rates. On a $300,000 home, that's $60,000. Yes, it takes time. Yes, it's worth it. If you go below 10%, really think hard about whether you're ready. Step 3. Lower your existing debt. Pay off or pay down car loans, credit cards, student loans before you buy. Every $200 a month in debt you eliminate could add $30,000, $40,000 in home buying power. Step 4. Build a cash reserve. Beyond your down payment and closing costs, which are typically 2 to 5% of the home price, you want 3 to 6 months of expenses in savings after closing. Buying a house and draining every account you have is one of the most financially dangerous things you can do. Step 5. Get pre-approved, then shop below that number. Use the pre-approval to understand your ceiling, then deliberately buy 10-15% below it. Give yourself breathing room for life. Job changes, family, the unexpected. Here's the bottom line. The bank's job is to lend you as much money as you qualify for. Your job is to figure out how much you can actually afford, and those are two completely different things. The 28% rule, the 3x salary rule, understanding the true cost of ownership. These aren't just numbers. They're the difference between a home that builds your wealth and a home that drains it every single month. Know your number, respect your number, and buy the house that fits your life, not the one that maxes out your approval letter. If this video helped you, hit the like button. It seriously helps this channel grow. Subscribe if you want more content like this. I'll see you in the next one.